Hello and welcome back to Managerial Accounting. This is Chapter 9, Budgeting. Learning Objective Number 2, the Master Static Budget. Okay, people, this is not my regular video. I want to provide a large, what are they called? Not like warning label, but just kind of like, warning label. This is not my regular video. My regular video is, I typically will do lots of applications. I like to use Excel. I struggled with this learning objective because I really do like the way that the slides laid it out. While not my preferred method, this one flows the best. And after a few different attempts, I'm going to the slides. These are unedited from the textbook. So what that means is that if you are the kind of person that typically likes to work on their own, maybe you listen to the videos, but because I, add some stuff to them, you're like, ooh, this is actually a good use of my time. You may wish to review the slides on your own and choose whether or not to listen to the video. That said, when I do add things, when I do talk, in addition to what's on the slides, I'll be pointing out where students have had difficulties with certain parts, why this is important. I'll be adding some commentary on top. However, if this is, fairly easy for you, perhaps you have done a practice problem and you're like, yeah, we're good, then please do not feel like you need to watch this video. And again, I say this with love and kindness. I will give you the best damn video that I can. But this is a very interesting one. It's actually one that we would probably spend even less time on in class because the practice problems are huge. So if you are not a regular tutorial goer, please go to this one because the application of budgeting is going to be so much more beneficial than me talking about budgeting, right? Conceptually, it's fine. Budgets, they're like the best plan for the future. They're going to be wrong because it's in the future and we don't know the future, but they're going to be our best guess and help us be accountable, like I discussed in learning objective number 1. But the best thing you can do is practice, because we're effectively layering on a forward-looking set of financial statements, block by block by block. All right, so without further ado, let us get into learning objective number 2, assuming you are well caffeinated. Okay. So here is what we are going to do literally. So we have a bunch of boxes and steps. We will be going through and we will be looking at our sales budget. That if we know how much we're going to sell, that drives how much inventory that we need. And if we know how much inventory we're going to need and we are a manufacturing company, that means we need to produce it. So that means that we need to have direct materials, direct labor, and overhead, which means that all of this needs to be funded with cash. Okay, and where do we get cash? We get cash from the income statement. And what happens when we articulate through the income statement? It comes to our balance sheet. And so then from here, this is kind of where we end up. And then we do it all over again. So we start with our sales budget, and everything ends with our cash budget on the balance sheet. All right, so step by step, let's start seeing what this looks like. So a sales budget is a detailed, scheduled showing the expected sales for the budget period. It is typically expressed in both the dollars and units of production. Units of product. An accurate sales budget is the key to the entire budget process. All the other parts of the master budget depend on the sales budget in some way. So when we look at the big picture, people, I would suggest taking a screenshot of this one and the next one because this will be walking you through the rest of the slides. When we look at the big picture, we need to know 10 questions, so answers to 10 questions. How much will we sell? How much cash will we collect from customers? How much raw material will we need to purchase? How much manufacturing costs, so our DL, DM, and MOH, will we incur? How much cash will we pay to our suppliers for our DL? And how much will we pay for our manufacturing overhead? What is the total cost that will be transferred from finished goods to cost of goods sold? How much selling and admin expenses will we incur? And how much cash will we need to pay those expenses? How much money will we need to borrow? How much money will we need to repay to our lenders? What about interest? How much operating income will we earn? What will our balance sheet look like at the end of the budget period? So while we're looking at cash, we also need to know, how does this translate to our balance sheet? How are we doing? Okay, so let's look at an example. You'll want a piece of scrap paper as we go through. Please do consider pausing the video as we go through. Really try to understand and walk through this, because at different parts, there'll be different times for different questions, and they'll be all related to this one big bad budget example. Okay. So we have Royal Company, and it's preparing its budgets for the quarter ending June 30th. Budgeted sales for the next 5 months are as follows. Of note, the selling price is $10 per unit. So we're going to take this and translate this into the sales budget. So we took $10 per unit, our budgeted sales per unit, and we see how many sales that we're going to have budgeted for the quarter end of June 30th. Okay, so what we did is we're looking at the quarter, which are 3 months. We're looking for June 30th. So we take our budgeted sales times by the budgeted price, and we get our total budgeted sales. Now, is this the same as cash? No! Will some students say this is the same as cash? Yes! So a big key differentiator here that we're looking for as profs is making sure that students understand that the budgeted sales are not the same as budgeted cash that we receive. And the difference for that is accounts receivable. Yeah, so accounts receivable that we receive for sales made prior to April 1st, as well as all the cash that we receive from sales within the quarter. Okay. So that is referred to as expected cash collections. So we need to look at some assumptions. In this case, for this example, all sales are on account. And what on account means is that no cash is collected from a sale. So we might be a big company, they might just have charge cards and no cash is exchanged. And therefore, we need to look at how often do they collect their accounts receivable. Well, they tell us that. They say that each month we collect 70% of that month's sales, 25% of the previous month's sale, and we have 5% uncollectible. So that means we'll sell, say, $100,000 worth of things, and $5,000 will never be collected. So that means that we'll never receive that cash. Okay, good to know. So then we're told what our opening April 1st balance is. And as you recall from Introductory Financial Accounting 1, because the balance sheet rolls over, the opening April 1st accounts receivable is what the closing month previously is. So the March 31st accounts receivable balance is our April 1st. So we're told that the March 31st of $30,000 will be collected in full. Fabulous. Let us take a look at what that looks like. So we need to first plot that out. We're like, great, thank you, March 31st. We're going to receive all of you in April. Fabulous. All right. Then we're going to get 70% of what's sold in April collected in April, and 25% of what's sold in April collected in May. Cool. Let's go look at May. In May, we're going to get 70% of what we sell in May, and 30% of what we sell in May, Interesting. All right, I had to go flip back for a second. So this should say 25% because it said 25% was collectible in the month after. And if we math it, 0.25 times 500,000 equals 125. So pardon me, her slide should say 25% here, but the math still math. So we're going to continue on. All right, so my question for you then is, if we were to go back and complete the cash collection budget for the quarter, what would the total amount of cash that is expected to be right here? So what would you have to do? You'd have to go back. And you do have a link either in your course notes, you have the PDFs, or you have a link in the slides below to go back and get the June sales. And remember that 70% is going to be collected in June and 25% the month after. So please consider completing the rest of this and figuring out what the total number of cash collected for this quarter is, because that's your next question. So give this video a pause, select the best answer, and then I'll see you in the next slide to see how you did. All right, welcome back. If you said D, 905, you would be correct. Let's take a peek at this. Okay, so we left off right here where this should have said 25%, but the math's still maths, so don't you worry. 0.25 times 500 equals 125. And then we have the last thing, June. We got 70% of the sales in June. We have 210,000. And so then we can get our waterfall. We add up all of our awesome cash to get 905 cash collected. All right. And that's the first of 10 steps. I said caffeine. Let's go to the next. Now it's our production budget. Now we know how many sales we're going to have. We now need to know how much do we need to produce in order to have those items that we're going to sell. In other words, production must be adequate to meet the budgeted sales and provide sufficient ending inventory. Because if we don't got it, we can't sell it. So management at Royal Company wants ending inventory to be equal to 20% of the following month's budget sales of units. Because again, you got to have it and a little bit more in order to sell it. On March 31st, we had 4,000 units on hand. With this information, the production budget can be prepared. So let's take a peek. All right, so if we have, this is all flowing through from previous slides, 20,000. 50,000 and 30,000 for a projected budgeted sales of 100,000. And we are told, back it up, that they want 20% of the following month's budgeted sales in units on hand. Then we need to figure out what is our required production. So we need to back it up from the end of March and figure out what do we have to have on hand at the beginning of April to satisfy April's sales. Okay. So we need to figure out that we need 10,000 units because we want 20% on hand. So 20% of the subsequent month's units on hand at the end of this month. So that's 10,000, 50,000 times 20,000 equals 10,000. I agree. And so if we need 30,000 because we need to sell, plus we need to have some on hand for next month, and our needs are 30,000. We are told in the previous slide that we have 4,000 as at March 31st, which means we need to produce 26,000 units this month. All right, but now what is the production that is going to be required to produce for May? Give this video a pause, try to figure out May, and figure out what number we need here for May. All right, welcome back. This is also a quick check. So is the number that you need for May 56,000, 46,000, 62,000, or 52,000? If you said 46,000, you are correct. So let's flow this through the numbers. We take our desired ending inventory for April. That becomes our beginning inventory for May. From there, we figure out what do we need for our, here, I'll just move it over one. Whoops, sorry. Oh, it's not letting me, okay. Went too far, went too fast. Didn't go through ahead. Wow, we're a little laggy here. There we go. Hopefully it doesn't skip ahead one more. Okay, we're good. So we need 20% for the subsequent month in our ending inventory. So that's 6,000. And then we have the number that we need to satisfy this month's forecasted sales. So we have 50,000 plus the 20% we need for next month equals 56,000 minus what we already expect to have on hand means that we need to produce 46,000 units for May. All right, and then we'll follow this through for June. June, we need $5,000, because in a prior slide with the information, we had July forecasted sales of 10,000. So then we need to take that times 0.2 equals 5,000. We're told here that this is also our ending inventory for the quarter. Yep, because June 30th is June 30th is June 30th. June 30th is a month. It is also the quarter end. So cool. So then that plus our 30,000 units means that we need 35,000 units for June, minus the 6,000 we had left over, that we expect to have left over from the end of last month, means that we need to produce what we need minus what we have equals what we need to produce, which is 29,000. All right, cool. And then add all these up, and we're told that for the quarter that this is going to be 101,000. So fabulous. We're like, cool. We anticipate selling 20 plus 50 plus 30 equals 100,000. We will have 5,000 at the end of the quarter. This is not a sum. Remember, this is a balance sheet item, so it's June 30th is June 30th, rolls over to the end of the quarter. That means we need to produce 105,000 for the quarter, minus the beginning inventory. Remember, the beginning inventory is the beginning inventory of the quarter, which was May 31st, which was also the end of the month for the April month. End of the month for the April 1st rollover. And that's 4,000, meaning that for the quarter, we need 105 minus what we have on hand at the beginning of the quarter, which was March 31st, which was April 1st, means we need to produce 101,000 items for the quarter. And if you add these up, boom, 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 that also equals 101. And all of this matrix adds as it should. Very exciting. All right, so this is your production budget. Cool. What does that mean we need to do next? Well, we now know how much we need to produce. Now we need to know how much direct materials do we need to have on hand. That, in other words, the direct materials budget determines the raw materials that must be purchased to fulfill the production budget and provide adequate inventories. Because if we don't got it, we can't sell it. And if we produce it, we need to manufacture it. And therefore, we'll need the materials on hand in order to do so. So here is some more information for that step. Using the following information, prepare Royal Company's DM direct materials budget. 5 kilograms of material are required per unit of product. Management wants materials on hand at the end of each month to be equal to 10% of the following month's production. On March 31st, we had 13,000 kilograms of materials on hand. Ooh, and note to self, material cost is going to be 0.4 cents, so 40 cents per kilogram. Okay, so let us build out our direct materials budget, and we're going to grab this from our production budget. So remember where we ended off last for our production budget is going to be where we start off for our direct materials budget. So we need to produce 26,000 in April, May, and June, these 46,000, 29,000 respectively, for a total of 101,000 units for the quarter. Great, let's start filling this in. So then we need to have 5 kilograms per unit. And we need 26,000 units. Great. We need 130,000 and follow it through. Then what did we have in desired ending inventory? We had 23,000, and that's because we need 10% of the following month's production needs in ending materials, raw materials inventory. So that means that for April, we need 153,000 kilograms of materials for April, but we already have some. March 31st, we had 13,000 units. So that means that we only need to purchase 140,000 units here. All right, good to know. Give this video a pause and calculate the materials that need to be purchased in May. All right, and so assuming that you calculated how much material should be produced in May, you would have come up with perhaps the correct answer, which is 221,500 kilograms, or answer A. So we would flow through our ending desired inventory for April, which becomes our beginning inventory for May. And then we'll go through the same process that we did in April and May. So we need 5 kilograms per unit, and we need 46,000 units produced. So that gives us a production need of 230,000 for kilograms for this month of May. Plus we need 10% of the kilograms that we need for the subsequent month. So 10% times our kilograms produced in June, which means that we need total kilograms needed of 244,500 minus our beginning inventory equals materials to be purchased for May is 221,500. All right. So now if we do the same thing for June, feel free to give this video a pause, go through the calculations yourself and prove it. And then I'll just point out the quarter. So when we look at the quarter, our expected ending inventory for the quarter is going to be our ending inventory for June 30th, because June 30th is also a month and it's also a quarter. So that's going to be the same here. Our beginning inventory would have been for the beginning of the quarter, which was the same thing as the beginning of the month for the start of the quarter. So our 13,000 here. So we run through, we need 516,500 kilograms for the quarter minus what we had on hand at the start of the quarter. And that means that we need to purchase 503,500 kilograms for our production this quarter. Okay. So notice how we said materials to be purchased, and this unit is kilograms. That's because we need to now look at how much cash are we going to be dispersing for the materials. Royal pays 40 cents per kilogram for its materials. One half of each month's purchase is paid for in the month of the purchase, while the other half is paid in the following month. That means that there's going to be an accounts payable that we owe. The March 31st accounts payable that we owe is 12,000. So let's take this information for what we need to purchase and turn that into a cash outflow or a cash disbursement for materials. So let's put in a similar schedule looking at cash disbursement for materials. At the end of the month, we have, at the beginning of the quarter or the end of the previous month, we have what we owe is $12,000. So that's going to be what we settle up this month. And then we look at our April purchase, and we're going to pay 50% this month and 50% next month. Now, remember, in order to get this $56,000, that comes from our needs of 140,000 kilograms that we need to purchase times by 40 cents per kilogram, and that gets us 56,000, half of which we pay this month and half of what we pay next month. All right, so sorry, I went a little bit too quickly. Please compute the expected cash disbursement for materials for the quarter, and know that you will have 4 options for A, B, C, or D. But hey, how about you just calculate the amount of cash that's needed, and then give this video a pause, do the calculation, and I'll see you in the next screen, and you can see if you have the right number. In theory, welcome back. What is the total cash disbursement for the quarter? Well, if you picked A, 185,000 for materials purchased for the quarter, you are correct. And the way that we got this was by starting off with where we had for the April, then looking at May and taking our production, paying half now, half next month, making sure to times our production by our 40 cents per kilogram. Half paid now, half paid in the next month, and then doing the same for June, taking our total June materials required, timesing it by 40 cents per kilogram, and then half of what we're paying in June, and then we ignore the other half. That's next quarter's problem. Add up all of these cash disbursements where we get 185,000. All right. So now we have direct materials, but we are still in production, people. We need direct labor. So we are going to incur direct labor in the month in which we use it because we can't inventory direct labor. These are people that we are going to be paying through payroll. So direct labor budget is calculated plan, looking at our labor requirements over a specific time period. Let's look at some more details on what we're looking at here. So at Royal, each unit produced requires 0.05 hours or 3 minutes of direct labor. Okay. The company has a no layoff policy, so all employees will be paid for 40 hours of work each week. In exchange for the no layoff policy, workers agree to the wage rate of $25 per hour, regardless of the number of hours worked. No hour overtime pay, okay? For the next 3 months, the direct labor workforce will be paid for a minimum of 1,500 hours per month. And with this information, the direct labor budget can be prepared. Okay, let's take a look at this. So we need to go back to our production budget because, again, the direct labor, our people, are going to be making products that are driven from what we need to produce. So that's going to be 26,000 units for April, 46,000 for May, and 29,000 for June. Our direct labor per unit is going to be 0.05. Remember, that's our 3 minutes. So now we see that we need 1,300, 2,300, and 1,450, except we guaranteed 1,500 hours. So then we're going to be doing the lower of, we're going to be doing either our guaranteed hours or what we need, whichever is higher. So since 1,500 is greater than 1,300, it's going to be 1,500. Since 1,500 is less than what we need, which is 2,300, it's going to be 2,300. And again, 1,500 is greater than what we require. So it's going to be 1,500, which means that we are going to be using this for our labor hours. Then we know that we're paying evenly across the board for $25 per hour. 1,500 times 25 is equal to 37,500, and so on until we see that we spend 132,500 in labor for the quarter. So my question for you is, what would be the total direct labor cost for the quarter if the company follows its no layoff policy, but pays $37.50, so time and a half, for every hour worked in excess of the 1,500 hours in 1 month? So go back and give this video a pause and see if it pays $37.50 time and a half for every hour worked in excess of 1,500, how much would that cost? And would they be better off? Give this video a pause and we'll see you in the next slide. So if they did in fact pay for time and a half, the only month that would be applicable for would be May. And that means that there'd be 4,500, so the 1,500 times by 3, so 112,500, and then the overtime hours for 30,000, then that would be 142,000. So that's actually not a good deal for them. They spent 132,500, and with overtime, they would have spent 142,000. So this actually works better for them in exchange for this month to have a no layoff policy. Plus, layoffs are pretty bad for morale. We definitely haven't seen widespread until probably this year or last, but definitely when I was in uni, when I was coming out of uni in 2007, 2008, around the financial crisis, that was a pretty dire time and definitely not a great mood for, honestly, just people in general. Because if you had a job, you were likely doing the job of 2 or 3 people. And then if you didn't have a job, it was really hard to get a job. And if you had a job and lost a job, that is also really hard. So if you know anybody going through that, give them a little bit of a hug, a little bit of a squeeze, and tell them it'll be okay. Economies tend to ebb and flow. Yes, we didn't have AI, but we had, other things. The world is constantly changing. So keep getting skills, put them in your skill set, and be a good, decent human, and be there for other people, especially when you can. Okay, so now that we are done with our manufacturing direct labor and direct materials, it is time to look at our overhead budget. So that's where we look at the schedule of all costs of production other than our direct materials and direct labor. Our case facts are as follows.